Hi everybody, my name is Kyle, and today for the next 10 minutes I'm going to be going over a new product called TrueNIM. So TrueNIM is a platform for community banks that will help you become more profitable by pricing your loans properly. Every single year, community banks lose millions of dollars because they do not price their credits properly. And on top of that, the technology that exists today, you have to tie into long-term contracts and is very expensive for a community bank to justify the cost. So they have to rely on building some sort of internal models with Excel sheets, or they just end up guessing, or they cough up the expensive cost of paying for these platforms. So TrueNIM is here to fix that. Let's just start by looking at the price associated with it. There's no long-term contracts associated with TrueNIM. You can buy as many seats as you want for your financial institution, and then you can cancel your subscription and take them away at any given time. I already have a subscription here, so I'm going to hop in and just show you the platform. When you sign up your financial institution, you are going to automatically be an admin for your system. So you will have things like user management and system configuration. You can add users here and buy more seats. You can invite users on. As you can see, I've already purchased 5 seats here, and I'm only using 1, so I have 4 available. And then there's a lot of back-end stuff associated with the system, but before we get into that, let's just run a deal through the system and show you what it looks like. I don't have to put in a deal name here because it's going to look at the customer and what product we select, and then it will automatically generate a name for me. So you can create your own deal stages within the system. Right now I just have prospecting in there, so we'll have that. I'll pick a expected close date. Now let's do a customer selection. Here I can create a new customer if I want, pick what industry they are in, and other CRM information that you could have associated with the customer. But the most important thing here is risk rating. This is very, very important when it comes to money you set aside per credit for loan losses. It's a very important part of understanding what your true profitability is going to be. So let's take a look and just go ahead and pull in one of the customers that we already have here with a risk rating of 5. And then I'm going to pick one of our products. When you start out, you're going to have 2 products, a non-real estate product and a real estate product, but both of these products are incredibly flexible to run all types of products through the system. So I'll pick a real estate product. Let's just keep the loan amount here. And then based on the risk rating as well as the loan amount type, there's an interest rate that is going to pre-populate in here that will kind of provide guardrails for your users. I'm going to override it in this case, and I'm actually just going to do prime plus 1 at the given moment. Then we have the maturity here, the amortization, but let me show you this. I talked about how with each product there's a lot of flexibility. So if I go in here and I'm going to change the payment type. So let's say this is a development, a commercial real estate development. Now I can go in here and change the payment type. We have a development period, and then we can actually set a draw schedule here, and it's going to impact our ROE. I'm going to get to that in a minute, but for just showing this, I'm going to go with a very, very simple P&I just to keep us on track here. But there's a lot of flexibility within the system that you can do to calculate what your ROE and ROA is going to be on a deal. So you got your payment type, you can select what your rate type is going to be, floating, fixed, adjustable, your interest calculation, your state, because this is going to be important for your taxes associated with this credit. Your risk rating can be overridden. Let's say there's guarantors that are backing this specific person. You can improve the risk rating right here. I'm going to keep it at 5 for now, but it is pulling from what the customer's risk rating was. And then you have business purpose. If it's a renewal or if it's new business, this is going to be all associated with operating expenses and how much time your people and all the costs associated with doing all of the back end work at your institution for making this credit. You got your payment frequency, which you can change if you want to do that. And then let's give an origination fee of 50 basis points here. You can decide if it's a participation. You can actually select it here and see how much you're going to be giving related to this deal. Then we have relationship deposits. So this is where we start looking at what's more broader on top of just the loan itself. We are actually looking at the entirety of the relationship. So let's say this customer is bringing over $50,000 maybe in a CD. So let's just say it's at 3.5%. This will impact what the total opportunity is going to be of the deal. We'll get to that in a moment. But we could also add risk mitigation, like if they have pledge collateral associated with it, which for a real estate deal, it's going to be incredibly common. And then guarantees, this is like government programs and different types like SBA and USDA. This is also going to be all associated with the risk mitigation piece and how much money you're going to be setting aside associated with a loan or lose associated with a loan. I'm not going to do it right now, but now we can take a look at what this deal looks like. So we're showing a 16.16% return on just the loan, but because they're bringing over some deposits, that actually improves. Let's say this got changed from an interest-bearing to a non-interest-bearing, and there's no rate associated with it, but it is still $50,000. You see how that went from 16 to 18.34%? That's because the cost of funds associated with this loan and that it can be used for other types of loans over a given time, improved the overall ROE of this deal. Now here at the bottom, you're going to see a traditional financial income statement. You'll see your interest income and your interest expense associated with the deal. So this cost of funds, I wanted to call this out because it is very important. Right now, we are doing a 5-year loan, 60 months. But if I change this, let's just say it was 2 years, for example. That's going to change the cost of funds because money isn't going to be tied up as long as it would be for 5 years. Now you can see that improved the cost of funds and it actually improved the ROE of the deal as well. So then you could start tinkering with the deal and understanding how you can make this deal become more profitable for your bank but still work for the customer. I'm going to go back and do 60 months here. But we keep going down through. We see your net interest income, your non-interest expense. So this is your operating expenses associated with it. So you have your annual expenses for servicing as well as your origination expenses. And then your provision for loan loss. So what you're setting aside for the lifetime of the loan based on the risk rating and the customer that is going to be getting this loan. Going down, you can see your pre-tax income as well as your income after taxes, after the state and federal tax have been taken into account. We're using Texas here, but if I switch it to a state that had a higher tax rate, that would impact that. But then you go down, you can see what your average balance is going to be over the lifetime of this loan, the capital that you're going to be allocating to it, and ultimately what your ROE and ROA is going to be. I'm going to save the deal here, and then we're going to look at some of the back-end stuff that is helping drive these outcomes. As an admin, you're going to have access to the system configuration. Now, when I talked about the lifetime of the loan, we are utilizing the treasury rate that is closest to that maturity in order to help get our cost of funds. So if I'm doing a 5-year loan, I'm going to be associating it with the 5-year treasury, but this is risk-free money. So I'm actually going to be putting a premium on top of both of those, or 2 types of premium on top of that funding curve, because we have a liquidity premium, which basically means that that money is not risk-free. As a bank, money is going to be coming in, going out, changing products, changing hands. We know that it's really not risk-free, and people can walk out with that money at any given time. So you have to add a liquidity premium on top of that. And then the other thing that we have here is a funding premium, which is really how long that money is tied up. The first rule of finance is that money today is worth more than money tomorrow. But for our first version, we are just putting a standard premium for this. But the idea is that the longer the maturity is going to be, the longer the more that money is going to depreciate over any given time. So money that is held up for 1 year is going to hurt you less than money that is held up for 5 years. So that is how we are getting the cost of funds associated with it. This is actually what best practice looks like within the industry. So that is what we have adopted for our first version of the product. Every single day, rates update, the treasury rates pulled in. You have market indexes that are also pulled in. You can change your risk ratings for your institution. You can do a 1 to 7, 1 to 6, 1 to 8, 1 to 9, whatever it may be. You have your probability of default, loss given default, your loss rate percentage associated with it, and then how much capital you would allocate towards that deal based on their risk rating. You can add more risk ratings if you want to do that as well. As you saw before, we have collateral types. This is all associated with your recovery rate and what your loss is going to be on any given deal. It helps benefit that. Same thing with your guarantees. If you have government programs in place that are backing a deal, then it's also going to improve your recovery rate. We talked about universal assumptions. We talked a little bit about deal staging. You can add your deal stages in if you wanted to create a full CRM platform. This platform allows you to do that. So you can add in different types of deal stages, whether it's underwriting or something like that. You can track the loan all the way to funding and so on, so even through maturity. We have taxes and regulation, which is going to be the federal taxes, and then your default state tax that you want to be based on where your financial institution is. And we have all the tax rates associated with every single state pulled in as well. Over here, you'll have the different products associated with your financial institutions. Admins are going to be able to change this, such as what the defaults are going to be, what payment types are allowed with each product, what rate types are allowed, and so on. And then even the channels associated with it. So the origination channels and servicing channels. If it's a renewal, it may cost less than if it's a new business to produce the loan. Same thing with servicing. So servicing isn't going to cost as much as the origination channels for collecting financial statements and whatever is going on associated with a credit. We also have deposits in here as well. You can add money market in, so that you can even see tiers associated with the money that a customer may be bringing in for a deal. Then you can just do a traditional interest bearing. So if you wanted to add CDs in here, maybe a 3-month CD, 6-month CD, you can do that for your financial institution and set a rate associated with it. And then we can tie rate sheets to each individual product. So we have a real estate rate sheet, which is tied to our real estate product, and a non-real estate rate sheet, which is tied to our non-real estate product. If I went in here, you can see that based on the deal size and the risk rating, we are actually spreading over prime here, but you can change what index you want to use. And this is what that rate that automatically pulled in when I was creating a deal was doing. It was looking at the risk rating and how large the loan was, and then it was spreading over prime. And that is pretty much the system as a whole. You can track all of this. You can add more people in. You can take a look at what your financial institution, all your bankers are doing and how much is in their pipeline, what deals are coming through. But that is the understanding of the system. And